Welcome, I'm Karen Moreno, the Fund Administrator at Mathers Associates. And thank you all for joining us here today for the third in a series of conversations with our investing partners. I'd like to take care of a couple of pieces of housekeeping before we get started. First, we invite everyone with any questions they may have to participate. Just use the link at the bottom of your Zoom screen where it says Q&A. Feel free to submit any questions there. If time permits, we'll do our best to address them at the end of our conversation or email you directly after the webinar. Second, we anticipate this conversation to run between 30 and 60 minutes. With that, I'd like to introduce Elliot Zeelander, the managing partner of Mathers Associates. We hope you enjoy our presentation. Elliot, I'll let you take it away.
Thanks so much, Karen. On behalf of our limited partners and my team of Karen, Jack, and Andrew, I'd like to introduce my friend and guest for today, Daniel Raynor. He is the managing partner and co-founder of Argentum Capital Partners. As a bit of background, Dan earned his bachelor's degree in economics from the Wharton School at the University of Pennsylvania and has been working in finance ever since. With over 35 years of private equity experience, Dan has nearly 40 portfolio companies that he has led for Argentum. His areas of expertise include, but are not limited to, technology-enabled services, business services, healthcare and pharmaceutical, and logistics. For those of you who don't know, Mathers has been invested in Argentum since 1993, when my father Norbert bought his first position in Argentum, not as an original investor, but as a secondary purchase. This was his first introduction to Dan and to his business partner, Walter Barandarian. And the relationship continues to grow and prosper. We are now limited partners in all 4 of the Argentum funds, and we are co-invested alongside Argentum in 15 different portfolio companies. So without further ado, let's begin our conversation with Dan.
Hello, Elliot. Very happy to be here. Good to see you, and good to see everyone who's joining us.
Thank you. Thank you for joining us. It's special to have you with us. Right off the bat, love to hear what you love or like about being in the private equity sector.
Well, before I answer that question, first, I will say that, actually, I met your dad originally in one of our earliest investments before your dad actually took a position, or Mathers took a position in Argentum. So my entire private equity history basically spans my relationship with your dad, my early relationship with your dad. So it's fun to be with you. I mean, look, I think as a career, private equity is a fascinating area. You're exposed to those areas of the economy that are most dynamic, that are most exciting, that are growing. It certainly also equips you to be a fabulous guest at a cocktail party, because you know a little bit about a lot. And as my wife says, you don't know a lot about anything in particular, but you do know a little bit about many, many things, because one of the intellectually gratifying things about this business is you meet really smart, creative people, and you basically help them solve challenges and build great companies.
That's awesome. I can agree with your definition of yourself and of myself. Of course, I'd say you know a lot more about each of the companies we're invested in, but that's your job. What led you to starting Argentum?
Yeah, so early in my career, a couple years out of college, I was working at a small investment banking firm that had also a very successful venture healthcare, early stage healthcare venture capital group. And so I got a very early exposure to the venture capital industry. And in those days, which I won't date myself, but it was many years ago, very small companies were being taken public. So, that was my first exposure really to the industry. At that point, it was really kind of early stage venture capital investing, early stage IPOs. And it really was sort of a great learning experience as a kid in my early 20s. So that was my first exposure to it. As I was at a firm for a few years. I met my partner, Walter. And, of course, young, impressionable kids, we thought we could do things better than the firm that we were working at. And, I think I was 28 years old, we decided to leave and start our own firm. And that was the time. There was real challenges in the markets at the time, and we felt that having a firm that would focus on raising capital for small emerging growth companies would be a great place to be. And so that's really what led us. And we struggled for the first couple of years, and but it was a great start. At that time, we didn't really understand what we were, but what turns out they have a name for what we were, and that was basically a fundless sponsor or independent sponsor. And that's kind of how we started the business. We did a few very successful investments, got a following, and raised our first fund in the early 90s.
Yeah, awesome. Well, you said there were problems with the industry, and in those days. Luckily, today the industries we're in are perfectly clean and have no issues, said tongue in cheek. But how would you characterize the difference today versus when you first got into this world?
Well, the industry has, dramatically professionalized. That's number one. But the most significant change is clearly the fact that an enormous amount of capital has gone into the private equity industry. And so that has clearly increased competition. It has increased valuations generally. And it's made it much more important for a firm to really have an identity, to have a very differentiated investment strategy, and to stick to its knitting. And I think this is one of the things I've learned over the years, is that if you do something well, just keep doing it. And that's what I think we've done very successfully at Argentum, is really stay within our lane, and not really go up market, not change our strategy, but just refine it, hone it, and stick to what we've been successful at.
Yeah, it's one of the things I really appreciate in dealing with Argentum and a few other funds that we've stuck with through 30 plus years of investing here at Mathers. What makes you guys special? I could go into it, but everyone would probably rather hear it from you. What do you do that's different as far as deal source and fundraising? And I'll let you,
Sure.
go on that.
So the essential elements of our investment strategy is, first and foremost, is that we are looking to invest in expansion stage companies that have been bootstrapped and are very capital efficient. So what that means is that they've been able to get past that early stage venture, high risk venture stage, without raising huge amounts of capital, right? So we are generally investing in companies that are at least 5 million in revenues, and that have gotten there through a lot of scrappiness and we're sort of the anti-Silicon Valley growth equity investors. We focus on all of our companies are recurring revenue. They're all B2B. They're focused in markets that are large enough where we can have a big win, but not so large that they're going to attract, every brand name firm in Silicon Valley. So, and then another element of our investment strategy, which is really important, is how much we invest in these companies. So again, if you sort of put all of what I said together, we're looking for companies that can scale with modest levels of capital. So we're investing $5 to $15 million in each of our portfolio companies. And in the growth equity industry, that's at the very lower end, right? Yeah. A lot of the firms that we compete with and that we competed, that were doing $10 or $15 million and making $10 or $15 million investments 10 years ago, their minimum check size now is 25, 30 million. So we think there's this enormous opportunity in the market to identify those scrappy entrepreneurs, capital efficient, who know how to make payroll and provide them with, more modest levels of capital. And we think it's a much less competitive area. And as a result, we're going to get, better returns. I'd say the other very important aspect of our strategy, which Elliot, well, is that in terms of how we source our deals, we have a very active outbound effort where we contact companies directly. We create investment thesis. We then have our business development group, which are two individuals who are full-time, focused on doing nothing but developing deal flow. And we contact companies directly, as opposed to going through investment bankers or brokers. I think of the nearly 100 investments we've made in our nearly 30-year or about 30-year history of investing, I think we've maybe gone through a broker 4 times, and not for the last 20 years. So that's very critical because we avoid highly competitive situations, and we really try to stick to our knitting, stick to those industries we understand where we can truly add value. And then we feel we've got, we've developed, a strong industry reputation in several of the verticals, some of those which you mentioned. And, so that's really, probably an overly verbose description of our strategy.
But a good one. And you were talking about how you source your own deals. Both Chris and Gene do a great job, getting out there and finding opportunities for you guys, and therefore not having to bid against others. And that's a critical part of what you do. Another, little difference for Argentum versus so many firms is that you use the SBA as a funding source. Do you want to get into that a little bit without getting too verbose?
Yeah, I mean, the advantage of the SB of being an SBIC,
yes,
which gives us access to the SBA as a funding source, is it's low cost capital, right? So it does enhance our net returns to our investors. So that's really the key fundamental difference. As far as our portfolio companies are concerned, it's really invisible to them because it has to do with our own balance sheet, our portfolio, how we fund our portfolio. However, because we are an SBIC, we have many banks, leading banks, as limited partners. And although that may not have been good the last couple of weeks, it's actually, and none of the banks that got in trouble are any of our limited partners. But having major banks as a limited partner is really a great opportunity because they can be very helpful to us. For instance, we had some companies that were banking at either SVB or at Signature Bank.
Yep.
And I'll get, I'll shout out one of our banking partners, Fifth Third Bank. They basically opened up accounts within 24 hours for our portfolio companies so that they had a place to move their money. So, I mean, that's one example, but also, banks are huge consumers of technology. And one of the areas that we invest in is fintech, which obviously, so banks have been very, some of our banks have been very helpful in terms of giving our companies advice or even becoming customers of them. So anyway, so I'd say, those are sort of the different aspects of being an SBIC.
Yeah. Awesome.
And by the way, the reason why banks are active investors in SBICs is because it is the only way most banks can invest in the private equity industry after the Volcker rule of Sarbanes-Oxley. So it is it's an exclusion for them, and so a lot of banks have used that in order to be able to continue investing in the private equity industry.
Yeah. One thing, we're talking about highlighting what makes, Argentum different and better. I think this year you won Inc.'s Founder Friendly Investor Award for a third year in a row. And I know from my experience with the entrepreneurs and CEOs and creators of these companies, I hear time and again, there were a lot of places for us to go for capital, but we chose Argentum. It might have even been a little lower valuation, but we see, such a great partner here. What does that reflect on you guys?
Well, so first, regarding the Inc. Recognition, I mean, obviously that's a marketing, it gives us good, nice marketing headlines, but it really goes to the essence of what we're trying to impress upon our portfolio companies, right? Because we are focused on bootstrap, highly capital efficient entrepreneurs. We're usually backing founder-led companies. So we're actually talking to the founder. So, that kind of recognition goes a long way in sort of proving our, making the case that we are the right kind of firm for them. But, beyond that, if you look at that list, on that list, is included some of the most, largest and well-known private equity firms, in the country.
Yeah.
But we're virtually the only one on that list that either invests on a minority basis. In other words, we're not generally control investors. We're not taking control. We're not buyout fund. And we're the only, we're the only one that's investing between sort of $5 and $15 million. Virtually all the other firms are much, much larger and investing, a much higher level. So recognition on that list is great for us because we're associated with all these, Vista Equity Partners, blah, blah, blah. But we're, again, one of the only few that actually are solutions for the kind of companies that we're looking to back.
Yeah. And you talk about, your 5 to 15 million. some of those firms on the list are $500 million investments.
Well, some are right, but I would say, probably the majority of them kind of fall in that 30 to, 150 million.
Yeah, well, 150 is a heck of a lot more than 5 to 15. So, no, you guys are doing great work, and it's what we want to hear from everybody. Let's see, where should we go? We've been invested with you through all 4 funds, where we continue to co-invest with you more and more. In regards to Mathers, is that typical for you to, I mean, I believe it's not, to have co-investors the way we're doing it?
Are you leading the witness here?
I'm leading the witness, indeed.
No, it's not. I mean, we really don't have any other limited partners that are similar to Mathers that have the same type of appetite and interest that you do in terms of supporting us and co-investing with us. Sometimes it's support we don't necessarily want as much as you want to give it, but but no, it's a great help for us. And because the banks, who obviously are very large limited partners and have invested a lot in our funds, they don't have that capacity. They don't have the ability to evaluate each investment. And so when they write that initial or make that initial capital commitment to us, that's it. I mean, they're great partners and they can be very helpful, but they don't look to invest in individual companies. So having that capability that Mathers offered, it is a good positive for us, because it gives us more flexibility in terms of either flexing up for a little larger investment, or when we make an acquisition for one of our portfolio companies, we have more capacity around the table than we would otherwise have.
Yeah, and we're grateful to be in this position, and it certainly makes our fund a little more unique than other funds. And it's I'm grateful to my father for setting up the relationship and building it, and I'm just feel lucky that I haven't screwed it up too much so far.
You haven't.
Okay, thank you. We wouldn't be talking if I had. Let me ask you this. In regards to the factors, when you're looking at the companies, there's a gut feeling you have. Obviously, you do lots of due diligence and look at the numbers. You look at the founders, you look for the competitive advantage that these businesses have. What is it that you're looking for, if you can sum it up in a few minutes?
Well, I mean, right, that's hard. I mean,
yeah,
there are essential elements, right, of companies that we like, right? Their business model, recurring revenue, large enough market opportunity, strong management, a repeatable sales process, low churn, high customer retention, positive macroeconomic factors, tailwinds in the business, all that kind of stuff. I mean, one of the areas that, we really like is vertically oriented software, mission critical.
You want to explain what you mean by that?
Yeah. So, a horizontal market would be one where everybody is a customer, right? Like, Google, right? Anybody would buy Google or an Apple phone or something. I mean, that's consumer, but Whereas vertical focuses only on a specific industry. So if you're in transportation logistics, it's only transportation companies that are buying that software.
Yep.
And why that's it now, the negative of that is the markets are by definition smaller, right? Not everybody would use that software, just a slice of the market in that particular vertical market would use it. But what's appealing to us about vertical software is those applications are much deeper. They are much more specific to the industry. And as a result, they're much more important to the business processes of the company. And then, on top of that, we want these processes to generally be mission critical, which means you can't run your business without it. And why that's important, of course, is if there's a slight, if there's an economic downturn, they can't get rid of it because they can't run their business, right? And companies also create their business processes around these mission critical solutions. So it really takes a long time to get rid of them. So those are kind of an element that we really like about the business. Okay, so those are kind of the elements, but you say, how do we make our investment decisions? Yeah. I mean, we look at every investment and there's no replacing doing the hard work, which is intensive due diligence on every front, talking to customers, talking to vendors, doing research on the industry, doing background checks on the principals, bringing in an accounting firm to do forensic analysis of the accounting and the financial records. Gut, yeah, you got to use gut to make decisions sometimes, but gut can't replace hard work. And so I wouldn't say we make our investment decisions on gut at all. We may make, decisions along the way on gut, but not our investment decisions. Now, when you do that kind of work, what you do come up with is a different conundrum, and that is that there's no investment that you're ever going to work on that is pristine, where everything is coming up, pointing, go. And if it is, it's probably because you just haven't done the work. You haven't done enough work. So the hard thing about an investment decision is weighing all the positives and the negatives, or the less than what you had thought it would have. And so that's really, I think, the challenge is just weighing all this data and ultimately coming up with the right decision.
Yeah. That segues into another question I have, and that is, once you're in these companies, and it's for our audience, so I'm leading the witness again. How influential are you in running them? I know you take a board seat on every company that you invest in. How can you explain to the folks how much you work with the companies? Because I know the answer to this,
right.
And then how much does it vary? Is there standard operating procedures? And in a few minutes we'll get into two specific companies, but
yeah. So I mean, although I would say every investment takes a kind of a life of its own, right? Yes. Our standard operating procedure is the same with respect to every investment, and that is, as you mentioned, we're on the board of every company. We have at least one board seat on every company we invest in. We would not invest in a company without a board seat. And we are also the lead investor. So we are the most active outside investor in all of our companies. And we also seek to become the leading advisor to the CEO. And we really start every investment with a pledge that we have a responsibility to help the company build value. We're not here just for the ride. We're not just investing money like in the stock market and seeing how it goes. And frankly, we won't invest in a company unless we believe that we can add positive value to the business. Because if we can't, it probably means we either don't know the subject matter or the industry well enough, and maybe we didn't make, maybe we're not capable of making a smart investment decision. And the other point is that, our time is just better spent where we can have maximum impact. So we want to channel our resources into the areas where we can have maximum impact on our returns to our limited partners, including Mathers. So yeah, and that value is not only being a good board member and advising the company on proper corporate governance and setting up comp programs. I mean, that's kind of table stakes, I would say.
Yeah.
I think where we differentiate ourselves is we add real value that goes above and beyond what most investors do. I mean, maybe the KKRs of the world do it. They do it. The Bain Capitals do it. But in our sort of area, our size range, I'm very proud of what we do. And that is, we originate acquisition opportunities for our companies. We will actually even initiate major customer relationships. Again, it's because we're investing in industries we know. So we know some of the big customers in the aviation industry. We have many contacts at Boeing. So we've initiated Boeing relationships for 2 of our aviation companies, as an example.
Yeah.
And then the other area, which is critical, is in recruiting C-level talent, because, as smart as we may think we are, and as a good investor as we think we are, the man or woman running the company is not always the one that should be running the company. And they may need, and even if it's not the CEO that you need a new CEO to bring in, but you need a CFO or a COO. So we utilize our network that we've built over these 30 years, and we've continuously bring in important C-level talent. That's a real critical element for our companies.
Yeah, and that talks to the depth you guys have, your advisory bench. I don't even want to go into it because I don't need to digress there. I know you've got CFOs from one company that moved to another over time. You bring them back, you recycle them because they're so good. We've got about 30 minutes left. I haven't seen any questions come in from folks out there. If you do have questions, feel free to send them in and we'll try to answer them. But let's talk about.
That must mean you're asking great questions, Elliot.
Or you're just really filling in my mild questions with verbose detail. Let's talk about 2 of the specific companies that you're invested in. One you've been invested in for about 10 years, the other for about 4 years. Fleetworthy is the one, an intelligence compliance platform in the trucking industry, and AdhereTech has a product that tracks an individual's medication consistency. They're very specific niche industries. Let's start with Fleetworthy. Can you explain what they do, who their clients are, why you liked them and where they're going?
Yeah. So those are 2 good examples, different, but
yeah,
very good examples of our investment strategy. So Fleetworthy provides technology-enabled solutions to leading trucking fleets that enable them to perform compliance, safety, and risk mitigation efforts on a very efficient manner. Their customers are the largest fleets in the United States to some of, to what I would call mid-sized fleets. They have a few smaller fleets, but mostly, their customers are Pepsi, Mondelez, Nestle, Tesla. For instance, Tesla has a truck that bring their cars to their dealers or to customers. So Red Bull. So they're doing business with all of these fleets. And when we got introduced to this company or to the industry through our investment in Transforce, which Mathers was a direct investor as well.
Yeah.
And in Transforce, we built the largest truck driver staffing business in the country, but sold it successfully. And along the way, we learned about how much compliance activities were done by these trucking fleets in order to keep their drivers compliant, in order to keep their trucks on the road. And it was a highly manual process. And when we dug a little further, so we started to say, hey, let's look at this industry. Let's try to find some companies in this industry that, provide these solutions. And what we found is that some of the largest fleets in the country were outsourcing or either doing it in-house very inefficiently or outsourcing it to these very small mom and pops.
Yeah.
So we found one of these mom and pops, one of these larger ones that was about a $5 million business. And we decided to actually buy a majority interest in the company. And our thesis at the time was that this was a very important element of these trucking companies, that it was being done very inefficiently, that technology was terrible, and that if we invested in the technology stack so that we could automate most of these activities and provide a nice dashboard so the trucking company would be able to see where they were at any given time, that it would be, it was a great opportunity. And, along the way, the company, when we invested, it was 5 million. It's going on 35 million now in terms of revenues. We've made a few acquisitions, and it's going to be a big winner for our fund and for Mathers. And, we've had some bumps along the road. We went through 2 CEOs that weren't the right ones, but we have now a phenomenal CEO for the last 3 years who's really created a highly profitable and really the market leader. And I think we'll get a premium value for the company when we sell it.
Yeah, I agree. And what's neat is that there's so many more trucking companies out there that need fleet-worthy services, and even, Pepsi's a huge company with a huge fleet of trucks, but there are many companies with larger fleets.
Well, actually, Pepsi is the largest fleet in the United States.
Okay.
Believe it or not, it's the largest private fleet.
Private fleet,
yeah.
Okay.
Because Pepsi also includes Frito-Lay.
Yep. And they're delivering a lot of sodas and bags everywhere around the country. Okay. But I do know that there are other, if we had tapped the market, that would cap the value on Fleetworthy. And
we haven't even scratched the surface. So Fleetworthy, interesting. So they have 17 of the top 100 private fleets. So there are 83 left in the private fleet, but then there's, the JB Hunts of the world, which is on the for-hire side, which really we're just starting to get into the for-hire part of the market. So your point is absolutely right. And there's a massive opportunity. And then the FedExes of the world, the UPSs of the world, which frankly, we just got a small contract with UPS. We think we're going to get a much bigger one. And and we're really the first to market with a full-blown end-to-end technology solution that will drive the in-house, whether it's in-house or if you want to outsource it, the compliance operations of a fleet.
Yeah, no, and it's really great because so much of this stuff were, sheets of paper in the glove compartment, travel logs and Excel sheets, but not even Excel sheets, just log books that would be turned in at the end of a road trip and then need to be entered in. And now, as I like to say, it's a little black box in the trucks. And, there's so much value there. I asked for some questions and I got a few. One, hello, Josh. I'm glad you're with us. Another one, and it's certainly not specific to where we are right now, but just curious how interest rates affect your economic modeling and your investment appetite. For myself, we're investing regardless of where interest rates are. And we're trying, and one of the things that's great about Argentum and our other partners is relative to the rest of the industry, we're on the low end of leverage. Any thoughts on that, Dan, before we get to Adhere Tech?
You mean how the interest rate environment is going to impact our investment strategy, or the investment or the industry in general?
Both.
Well,
but specifically to you guys.
Yeah, I mean, I do feel the interest rate environment, coupled with what's happened to the banking industry over the last couple of weeks, is going to slow down the economy further. And the reason for that is banks now are going to be much less concerned about maximizing their profit or their ROC, which is return of capital, which is a very important benchmark for them. Instead, they're going to be focused on liquidity and safety. So I definitely see them reducing loans and only lending on safer investments. And the less lending there is, the less economic growth there is. So I think this will definitely slow down the economy. So given that, I mean, how it impacts our investment strategy is, again, I mean, really staying away from industries that will get hit badly by the downturn, and staying away from interest rate sensitive, overly interest rate sensitive industries. Now, we invested in 2 mortgage tech companies, and they had a couple of tough quarters there. So I mean, our timing doesn't look great with those 2 investments, but our thesis, we feel continues to be very viable, because in fact, the technology that will enable mortgage originations more efficiently, frankly, is more important when the mortgage industry is tougher, when it's tougher to originate loans. So we actually think, even though it's maybe not growing as fast as we had hoped at the outset, that ultimately it's actually going to add to our success in those 2 investments. But yeah, anyway, that's kind of my answer.
No, that's great. And actually, in regards to those 2 mortgage tech companies, your relationships with the banks have helped. Very much so. Let's move to Adhere Tech. They have smart bottles. They in the last month or so have gone live with smart caps. They're used for very expensive drugs that the pharmaceutical companies manufacture. There's a direct ROI to the pharmaceutical companies who pay Adhere Tech. Do you want to, expand on that?
Yeah, I mean, what really, I mean, we've been investing in the healthcare IT and services sector for quite a while. It's maybe been our most successful sector. That and probably transportation tech. What really appealed to us about AdhereTech is, we've never seen a business that generates as high a value proposition and an ROI to its customers. When we invested in the disease management industry several years ago, a 3-to-1, 2.5 to 3-to-1 return on investment was considered kind of, what you were shooting for. And if you delivered that, you could get customers. Well, with AdhereTech, they're generating 15 to 20 time, returns on each dollar invested, because they're basically, because of their communication to the patient, the patient is improving their adherence by that much. And it not only that, but it's giving critical information to the drug company, it's giving critical information to the specialty pharmacy, and it's giving critical information ultimately to the doctor. So, we see this as a really, someone's been trying to crack the code here for years, and AdhereTech is really the one company that has developed commercial traction and gotten approved by some of the leading drug companies in the United States. You mentioned the smart cap, which is really an important, really a game-changing event, because what it does is it probably triples the market opportunity, because with the smart cap, instead of the patient having to take their drugs out of their original bottle and putting it into the AdhereTech bottle, all they have to do is take the cap off and put in the new cap. And why that is important, it's important for two reasons. First, on the drug company side, the FDA does not want certain drugs to be taken out of the original bottle by the patient. And even if the FDA is silent about that with drugs, a lot of drug companies are uncomfortable about that because they don't know what's happening. They lose control. So by again having the bottle staying in place, it increases the amount of drugs and the amount of drug companies that are interested in using the bottle. But it also, and this is even more important, it opens the entire clinical trials opportunity for the company, because those drugs you definitely can't take out of their original bottle because they're not necessarily stable yet, and they're still going through the drug approval process. And so by having this smart cap, it's going to enable access to that clinical trial market, which is, very, very large. So yeah, we're really excited about it. We think it's a very opportune time to be investing in the company, and it's very timely.
Yeah. Now this is for obviously the most expensive drugs. The product, it's awesome. It's made in the US and manufactured in the US, and each bottle or now cap has its own semiconductor chip, doesn't need to be turned on by the user. They're truly smart products, and just more of this, the internet of everything out there. Over time, is this a market that can expand? Do you see it going to less expensive drugs over time?
Yeah, so even the smart cap itself will be less expensive, and right now, as you correctly point out, we've been targeted at drugs that are basically drugs where subscriptions are, prescriptions are at least $2,500 or $3,000 per month. And that's just because the ROI is just that much higher, right, to the drug manufacturer. But it also means that you're dealing with drugs that are very important, right? They're life-saving drugs. They're, a lot of the drugs, are for cancer, are for chemo. Our biggest drug was the leading drug for chemotherapy, that was used after chemotherapy. So
Yeah.
MS drugs were, the company's about to be launched with one of the leading MS drugs. So these are very, drugs that really, if not life-saving, really very, very important. So we're going after that market because that's the low-hanging fruit. But, as the company scales, the pricing is going to go down such that, yes, we expect one day to be able to go after drugs that are probably as little as $300 or $400 per month.
Okay.
It's never going to be going after Advil, but
Yeah. There's always more. But just like these smartphones have gotten, it's amazing what they can do. There's no reason that the pill bottle or the pill cap can't continue to, improve and lower cost. And it'll be amazing to watch how it plays out.
yeah. Ellie, the one thing to point out is even though AdhereTech, has a physical product that's being in essence delivered, really what the pharmaceutical company, which is our customer, it's not the patient who's our customer, right? The pharmaceutical company is paying us or AdhereTech in order to deliver this service to their customer. The customer benefit is their adherence improves, their healthcare outcomes improve. Obviously, the benefit to the pharmaceutical company is that, the flip side of higher adherence is that they sell more drugs, and these are very profitable drugs. So they're getting a huge return on it. But even though that's we're really getting paid for the whole communication. It's the data, and it's not, the margin's not on the product. The margin is on the service. So this is a very high margin. Right now it's in the 60s, but ultimately we think it'll be 75, 80% gross margin, very similar to other software, SaaS or data type products.
Yeah. I just want to pivot as we're, as time is running and we want to keep this under an hour. I've got a question from Professor Janet. And she's asking about succession planning in the investment companies and in Argentum. And one of the things I always point out to folks is between our co-investments and our capital commitments to folks like you, that represents roughly 70% of Mather's investment. So God forbid something happens to myself and my team, that 70% of those investments, tears are shed, but those companies move on without much of a hiccup. What happens? Do you look at that within the companies and within your fund? I know you continue to build the size of your firm out.
Yeah, I'm not going anywhere, I don't think, for 5-7 years. But yes, we have some younger, really smart people who are doing really well at Argentum, and we definitely have our ideas about who's going to be leading our firm. We're not looking to end our firm when we retire. We're hopeful that it's going to continue on, and that the people we've hired over the last 20 years are going to basically take it from where we've left it and make it even more successful than we have, and that's certainly our aim. in terms of our companies, it's a little different answer because, the reality is that the average investment that we make has on average, I'm going to say a 3.5 to 6 year horizon. So, given that most of our founders, CEOs that we're backing are anywhere from 35 to 45 in general, there are a few older ones. Succession is not the primary topic. That the succession is usually the challenge of the firm that we're going to sell it to, right? And so, very, very frankly, it's really not a major issue that we spend a lot of time on with our companies. I mean, maybe in certain ones we should spend time, but I don't recall in our 100 investments, I don't recall once where somebody that we invested in retired voluntarily. We retired some of them involuntarily, but that was because we wanted a new CEO, right? Or we thought, and you've been involved with a few of those, Elliot.
Yeah, and I'll just say to that, we're still grateful for the the CEOs of what they created and brought to us, and without them, the companies wouldn't be there. But yeah, so not everybody can take a company to the next level, to the next
Right.
level, next level.
I don't know if that answers your question.
Yeah, no, when I talk to Janet, I'll find out from her. It really brings us to the end of our discussion. Maybe we'll do a part 2. We've got a lot more companies to talk about, but I want to thank you, Dan, for joining us. I want to thank, it looks like we've got close to 30 participants, and I know a lot of people couldn't make it today and they'll be watching on the replays. But just to make these webinars as useful and informative to us and for our limited partners, it would be helpful if anybody out there has any feedback. There are a few questions I'll get back to you on after the meeting. And as soon as our presentation ends, which will be momentarily, we'll be sending out a short survey that'll pop up. And if you don't mind, we'd really appreciate your feedback. So any last words, Dan?
No, again, Elliot, I value our relationship, and the most important thing in building a relationship is trust. And I think that's something that we've established, that I've initially established, with your father, and that has certainly continued on. And no, very pleased to be part of this and enjoyed it.
Thank you. Thank you. Right back at you. And just want to say thanks to everyone, and we'll talk to you soon. Bye-bye.